Chapter 3, which focuses on sales and receivables. In week 5, we'll start our discussion of sales and receivables. So sales are cash, or the right to receive cash, because the company performed a service or provided goods that are part of the company's normal business operations. Since we're using the accrual method, when the goods are delivered or the services are provided, the customer owes us money, i.e. the receivables. Generally accepted accounting principles are very specific about when a company can record sales. There are 5 criteria that need to be met. Number 1, the risk and rewards have been transferred from the seller to the buyer. Number 2, the seller has no control over the goods sold. Number 3, collection of payment is reasonably assured. Number 4, the amount of revenue can be reasonably measured. And number 5, the cost of earning the revenue can be reasonably measured. Now, again, it is extremely important that you understand how to recognize revenue. The software, QuickBooks, is not an accountant. You are, or you will be. The software will only do what you tell it to do. In week 6, we will finish our discussion of sales and receivables. More specifically, how to record cash received from accounts receivable. We'll also discuss how to record credit memos, which are adjustments to the bills, either due to an error, customer dispute, or some other concession or promotion. The textbook talks about how QuickBooks uses this account called undeposited funds. Now, I had to read this about 4 times to understand it, so I figured I would take the time to explain it. When the company receives cash, it is not immediately recorded into the company's bank account. Instead, QuickBooks records it into a temporary account called undeposited funds. Imagine that someone owed you $50 and they approached you on campus and gave you a check for $50. Well, that's great. They don't owe you money anymore. So you need to record that in your memory or in your accounting records that they no longer owe you. However, your bank account does not know that you received $50. So you have to then deposit it into your bank account. But while the check is still sitting in your pocket, it is an undeposited fund. So that's what they're referring to. Yes, you have it, but the bank doesn't know about it yet. So QuickBooks is putting the check in your pocket, and then at a later date, once the funds are actually deposited, then you would reconcile that and transfer the money from the undeposited funds account into your bank account or your cash account. Okay, so that's a high level of chapter 3, focusing on sales and receivables. If you have any questions about how to account for sales or how to account for accounts receivable or the accrual method, I highly recommend you visit some of the tutorials that I have and videos that are on Canvas website, or you can even go to YouTube and identify some good videos there, and feel free to share them with me and the rest of the class. And if you have any other questions, of course, you can always put them in the Chapter 3 Ask a Question. Have a great week.